Standard Threes, and this is Richard Farmelo. We're here to talk a little bit about markets. We've had a degree of turbulence since the end of January, having had a very flat 2016. And we just thought it worthwhile us talking through some of the reasons to why that might have happened and what it means for investors. 2017 was extremely flat.
Well, not flat in terms of market performance.
No, but in terms of volatility.
In terms of volatility, it was highly unusual.
Yeah.
To go a whole year without a move of more than, I think, what was it, 2 odd percent?
3%.
3% in markets is highly unusual. And I think that's why the recent correction came as such a shock to people who were getting used to such low volatility. Yeah. Which actually is not the norm.
No, it's also, I mean, you're not quite sure how often Minsky and the Minsky moments can be referred to.
Just to clarify that, Minsky was an accountant and, an economist who said that stability eventually leads to instability.
Yeah. Because people's behaviours are modified by the stability, and they essentially load more leverage, more amplifying factors into it, and eventually breaks down. So it leads to a larger movement, having had a long period of stability.
I suppose you could sum it up by people get complacent and take more risk, and that's when things are stable. And then
or the calm before the storm. Exactly, there's lots of analogies you can use, but interestingly, Minsky was a little regarded as an economist until the financial crisis. And his work then has become much more widely read and understood and referenced. But I wouldn't say what we've experienced is in some way comparable to the financial crisis, but we had a very long period of slow accretion of markets. And then it came off a cliff a little bit at the end of Jan.
Yeah, I think, as I say, I think we've been in the industry more years than I care to remember, and a 10% correction was nothing really to shout about. No. It happened on a very regular occurrence.
Yep.
And I do believe that this is just a blowing off some of the froth. Yeah. Rather than heralding the end of the bull market.
And I mean, not in any way seeking to amplify the number of years that clearly a man of your advanced age has been in the industry. Because you joined how many days before the stock market crash?
Well, August 87, August October,
So we've been through a few of these, and technically it is called a correction. A correction is when you get a fall of 10%. And so in the US, it was just about 10%.
Yeah, I think they were.
In the UK, we were just under. And there's since been a recovery. But I mean, what it has brought back in is some volatility, which we think is a helpful thing.
Yeah. It's a healthy thing, I think, for the market. Yeah, absolutely.
And one of the things that having a bit of volatility does is a curative. It cleanses the system of some things which accumulate during periods of unnatural trading. One of the things we want to highlight is you get, there's an index called the VIX, which is a measure of volatility. And you get some very clever people in investment banks deciding, let's make a product which goes up and down depending on how much volatility there is. And then you get some even cleverer people then say, why don't we add some leverage to this? And why don't we have an inverted one so we can short the volatility? So if the volatility stays very low indeed, we'll make money. And so having made these products and sold them to a lot of highly sophisticated, in inverted commas, investors, over the course of 2 days, some of these funds managed to lose 90% of their value as volatility increased.
Yeah, I think you can trace it back to central banks. I mean, in actual fact, there's some evidence that central banks were actually selling volatility to keep the markets calm for quite some time.
Yes,
but you can sum it up as not much volatility in markets, and therefore these products were invented to make profits on that, and that worked very well for several years. And then in the space of 2 or 3 days, all of those profits were lost, and the products,
died.
Went bust, which is incredible.
I mean, it's not really about naming names, but the chief executive of Credit Suisse said, and I think I'm quoting here, he said the product worked very well for a long time until they didn't.
Yeah, that's right.
Which is, I mean, for the record, that is the antithesis of what investing should be. That's not long-term investing at all. That's a guy trying to make a punt on a product, and that is casino banking.
Yeah. But again, it's although we know what it is to most people, it would, you know, it is and sounds like a complex product.
Yeah.
And the more complex an investment, you know, the more risk inherent in there. So
That's right.
you know, that's
So
why-
certainly
that's-
as investors we steer
Yeah.
so far
Yeah.
away from those things. You take one look at them and you don't look any further.
Well, exactly. You know, investing is best when it's kept simple. I think.
That's right.
So,
Now, inverting that, it's probably worth just having a quick conversation about another sort of very prominent UK investor who's had a bit of a bad run, Neil Woodford.
Neil Woodford.
Now, Neil Woodford had a fantastic record in Invesco, and he used that record to set up his own fund and own fund management company. And it's fair to say he hasn't had the best of recent times.
No, I think his fund is sort of near the bottom of the rankings over certainly over 1 year. But far be it for me to criticise someone who's got such a terrific track record.
Yeah, he's done extremely well. But I just, you know, it's the interesting for me is, I mean, all fund managers go through sort of bad runs, but it's just he's had a dreadful run. And do you see in some of the companies that he's invested the seeds of why that run has come to an end?
Well, it's always difficult. I mean, he made his reputation at Invesco Perpetual, and it's always difficult. And this is not Neil Woodford per se, but this is across the industry. When a star fund manager moves from a large organisation and sets up to a degree on his own. I mean, obviously it's not just Neil Woodford, he's got people around him, he's got a team. But whether the team at Invesco Perpetual were perhaps more responsible than they were given credit for his success at Invesco Perpetual, that's always the question that as an investor, if you're investing in funds, that's what you want to ask. You know, is it all down to him, or was a lot down to his team at Invesco Perpetual? And is that the reason, since he formed his own business, Woodford Capital, is it? Is that the reason for the success, and is that the reason why he's struggled since he's moved? You know? I mean, obviously, you know, investors followed him in droves because he manages 10 billion plus. But how long that will be sustained, it's, you know, it all depends when his performance is going to turn around and if it turns around.
That's right. And in terms of some of the companies that he's been invested in, there have been some notable
some notable failures. He was
Now, it's worth looking at some of those because they're companies that we wouldn't look at.
No.
So companies like sort of Provident Financial, which has had a very difficult time. Again, it has sort of balance sheet cash flow issues, which preclude it from being something that we would look at very seriously.
Yes.
You've had others like Capita, again, where you have very long-term, hard-to-measure contracts where the profitability is marginal at best.
And again, the cash flow characteristics are very poor.
And even if you like the management team, you still look at that business and say, you know, that should be on a low rating because it's an intrinsically low-quality business.
Well, his most recent one was AA, which you know has halved in value over a few months. And he has been acquiring more shares there.
And the one thing that you would add to all of those, which has come back in, you know, when companies have poor performance, that's one thing. But the difficulty is when they have a lot of debt.
I mean, that's what kills companies.
Exactly.
It's not a period of poor trading. It's a period of poor trading combined with a very high level of debt means you're at the mercy of your creditors.
That's right. When it makes it path dependent.
Exactly.
And so you see that with AA, another company that had been through the hands of VCs. Came back to the market loaded with debt, needed further investment, and when poor trading coincides with that additional investment required, you lead to a significant fall in profits, and you then lead to existential questions about the company's capacity to fund its interest payments.
I'm not saying that we haven't had stocks that have encountered more difficult trading than we anticipated, but we try to limit that by choosing companies with usually very low levels of debt, or
ideally
more,
lots of cash.
Usually they've got most of the companies in the portfolio have got net cash balances. So it does help, doesn't completely eradicate, but it helps mitigate those risks.
So we've had this fall off in markets. They seem to have stabilised a little. As to where they go in the short term, we have no idea.
Well, I think you know, we're not technical analysts. We're more fundamental analysts. We look at the operations of the company, the quality of the business, the balance sheet. Technical analysis relies on charts and to provide trading signals, which is not really, we don't really use it in a great way. But In terms of corrections, often what happens is that they're useful reason they shake out the loose holders, the people who are nervous and are willing to sell if the markets take a little bit of a downturn, and that in turn forms a solid base for the next advance. And as I said before, I don't think this heralds the end of the bull market. I think it provides maybe a platform for the next and maybe final leg of the bull market. Who knows? But
certainly, what was advantageous for us is we had significant amounts of cash as the market ran up, and then as it's come down, it's given us the opportunity to deploy that cash.
Yes.
Now the froth has come off the markets, and again, should markets push on significantly further, we'll be reversing that process. But in the short term, it's impossible to say where markets are going to go.
No.
There's going to be more volatility. I think everyone recognises, and also I think the most important players in the game, who still remain the central bankers, have acknowledged that maybe volatility was too low and it was encouraging excessive risk taking. So I think to a degree, as long as this correction doesn't develop into something more severe, they're quite happy to see it and to get investors more used to the risks within, and not just equity markets, bond markets as well. Yes.
So I think they're quite happy to see what's going on in a rather perverse way.
Yeah.
And they're gradually withdrawing liquidity, so they'll continue to do that.
Navigating the path of rising interest rates in a post-quantitative easing environment is not something anyone has any experience of. So, our guess is that the central banks will take it cautiously, but it's a path that hasn't been travelled before.
No, we're in uncharted territory in that respect. Absolutely.
Yeah. Okay. Thank you for that, Richard.